So my name is Kamal Hassan. I'm one of the managing partners of Loyal VC, a global venture fund, and we're here to talk about venture capital and share a little bit of the knowledge experience we have for how wealth managers can think about venture capital and adding it to your portfolio. I'm joined here on the call, among others, by the other managing partner, Michael. If you want to say a quick hello, Michael.
Hi, Michael. Yeah.
Sounds good. All right, let's kick things off here with the talk itself. So I'll share a screen here. So this is a primer on venture capital for wealth managers. And it is targeted very much at people who think about managing wealth for other people. That is who this talk is targeted at. You will learn things if you're just interested in venture capital anyway. But just to give you the heads up, this is really targeted at people, and everything will be expressed as if you are managing someone else's wealth other than your own. So yeah, let's jump into things here. Just as quick background, I'm one of the managing partners of a venture fund here, Loyal. I've been an entrepreneur for about 20 years, investing about 15 years. I'm a former consultant from Bain & Company, and I jumped into the space of private investing with a lot of confidence. I was did an undergrad in engineering physics, top graduate in my MBA class, a consultant at Bain & Company, a successful entrepreneur. And I thought this was a very predictable, easy to understand industry, and given some of my own experience, and I quickly learned humility in doing it. Now, I did very well with my investments. I have a 4.6x realized return from my investments, which actually works out to about 11.5%. So it's not great, it's not horrible, it's decent, but I learned a lot in doing that, and that caused me to do a bunch more research in the industry, which we'll share with you here. But my results were exactly industry average, which were 7 of my investments failed. 2 of them were unexciting, and 1 investment was what we call a home run in the industry, where I got 30 times my money back, but that took me 14 years to get there. So that's my personal experience that informed what I've done since. But let's jump in and talk a little bit more about what it means to be a wealth manager. And being a wealth manager is all about balancing risks. And there's really 3 big risks you're trying to balance when you're looking at your client's portfolio. The first is the risk of loss, the risk that your client's going to get back less money than they invested in any investment. And there's a big concern for many wealth managers about investing in venture capital, because venture capital funds, as traditionally practiced, are very risky funds. Now, they don't have to be risky. And what we'll do is we'll show you in this talk how you can de-risk a venture capital portfolio to actually make it appropriate for use with clients. The second challenge which people run into with venture capital, and the second risk you're trying to balance off, managing clients, the money, is liquidity risk. So you're worried that the client won't be able to access money when they need it. And you are very familiar with what happens with calls with clients when they want their money and you can't give it to them. The big challenge here, of course, is that most VC funds are illiquid. Our fund is not illiquid. We'll talk a little bit about strategies you can use there. Now, the third big risk you have, and many people focus on these first 2 risks. They think about, okay, there's a risk of loss, there's a risk of illiquidity, and let me manage the portfolio to just reduce losses and keep everything liquid. There is, however, a third big risk, which some managers don't always keep top of mind, and that is longevity risk. The risk that your client outlives their savings. And this is the reason to be thinking about venture capital, is venture capital can make a big difference in the long-term returns of your portfolio and will allow your clients to get the returns they need to get the lifestyle they need, even if they have a very long life. And this is where venture capital generally outperforms. And I'm going to start with this because this is the good news here. And let's just show you some data on this. So I mentioned private equity and venture capital generally outperforming. Here is data from the past 5 years. I picked the past 5 years because our fund has been around past 5 years, but you can run those as 10 years, with 20 years of data, whatever you want. And you can see here, I've got a chart where the vertical axis is the most important one for the discuss of longevity risk, which is the annualized return on investment from each of these different asset classes: bonds, equities, private equity. Now, the horizontal axis is a simple measure of risk. It's the largest possible loss, the drawdown over the past 5 years. And you can see investments follow a classic risk return. I mean, in reality, in the past 5 years, the numbers have followed a classic risk return curve where bonds are lower risk and lower returning than equities, which are lower risk and lower returning than private equity. And other assets like real estate, gold, even crypto fall very much on this risk return curve. So this is what's interesting up here is private equity and venture capital are, generally speaking, a higher returning asset class than equities. This is why you want to think about it to address that longevity risk. Now, there's a couple of other ways of looking at this data. There has been interesting evolution in the market, and we all know that there's massive amounts of returns being generated in technology. I mean, things like ChatGPT coming out are going to have a large effect on the economy, and the question, and we know that tech returns can be astounding. In the sort of older days when Microsoft, in the older days, companies would go public at a very early date. So Microsoft or Amazon, you could have got 3,000 times the initial money you put into them by investing in them when they first listed on the public markets. Now, this has changed over the past few decades, where Google, just 7 years later than Amazon, listed 7 years later than Amazon, you could have only have got 70 times your money. And if you look at Facebook or Uber, then you're looking at a sub 10x return. What is going on is that companies are staying private longer and longer. Venture private equity investors are giving them more attractive offers than they get on by listing via public markets. And the result is, if you want to access these large multiple returns, which are created in tech, you need to invest in either VC, private equity, or try to find the few public market vehicles which get into those earlier investing, or you will never access those returns. You'll be limited to still very good returns, but capped returns. Another thing to think about is the importance of private companies to the economy. So if you're just trying to match the economy, I mean, we all see things in the paper which say private companies are the engine of the economy. They've dealt with, they sort of hired the result of dropping unemployment. It all comes from private companies. Well, yeah, that's true, because guess what? Even though we all think about public companies, which is where the money's invested by most wealth managers. And the thing about public companies is you're accessing less than 1% of the universe of available companies. And this is just data for the US, by the way, and the US has more sort of a higher propensity to list public companies than other countries do often. So you've got less than 1% of all companies are public. Of course, many public companies are very large. If you look at the total sales in the US economy, though, 57% of the sales come from private companies. By economic weight, they are more than half of the economy. So you should be thinking, if you've got a certain amount in public companies, you should be thinking about matching with an equal amount in private company assets if you want a balanced portfolio. This is still under work. This chart here, this is work we're doing ourselves to break out how global wealth is distributed across different assets. And one way of thinking of this is to think, well, this is what a neutral portfolio for my client would look like if my client's wealth was distributed the way global wealth is distributed. And of course, we all know about real estate investments, and it's pretty well every client's portfolio. It's about 30% of the portfolio, should be half residential, half commercial, industrial, a little bit of farm. The next big one, which everyone has, of course, is public equities. That should be 22% of a portfolio in a balanced portfolio matching global wealth, and bonds should be about 20%. The next big chunk here is private equity, which should be to match this 16%. And then you have things like infrastructure, which should be 5%, and a number of other smaller assets, even including cryptocurrencies, which should be 1% of a balanced portfolio. So this is what you want to look at very roughly if you're matching global wealth. And this is actually something which is very well known to top institutions. If you look at top institutions and how they manage their allocation to alternatives, which is pretty much most things other than core real estate, equity, and bonds, you can see that many institutions have on the order of 10 to 20%, sometimes as much as 50% of their portfolio allocated to alternatives, whereas high net worth individuals, very high net worth individuals, which is who wealth managers are serving, have a fraction of that. And there's really, if you want to match what top institutional managers do, if you're thinking about the long-term health of your client's portfolio, you really want to start thinking about how to allocate more to alternatives, primarily private equity. And venture, of course, which is a subcategory of private equity. So that's been talking about the longevity risk, how to deal with clients outliving their savings. And obviously, venture capital should be very seriously considered as part of your portfolio to address this. Now let's talk a little bit about the loss risk, because this is why many people haven't invested in venture, is they see it as risky. And as mentioned, we'll show you how to de-risk. And in fact, I'm just going to jump to the end answer right away, which is there is no secret to how to de-risk any investment. You need to diversify suitably. What you want to learn here, though, is the rule of 500. We all know, anyone who manages money knows that a diversified public portfolio should have at least 20 investments in it to be considered suitably diversified. And investing in only one stock is a crazy thing to do. You want to diversify that portfolio. That is how you de-risk. That is how you preserve wealth. What is not commonly known is to match the level of a 20 investment portfolio in the public markets, you need to make 500 underlying investments in venture capital. This is the sort of magic number equal to that 20. Now, to get 500 investments, yes, you can make 500 investments yourself, which is pretty impractical. Most venture funds have about 15 investments in them, so you can make 30 or 35 venture fund investments. Now, you're probably going to invest in subsequent funds from multiple managers, so this really comes down to picking 10 to 15 venture managers, which is what many of the larger institutions will do. The other alternative is to invest in diversified funds, such as the one we offer, or in fund of funds, which are widely diversified. Always remembering you want to have the 500 underlying investments, and that is where you de-risk this asset class. Now, how do we get to the number 500? I'm going to show you a little more math here, which is these are the probabilities of different types of outcomes from venture investments. And this is based on 20,000 venture financings gathered by a group called Correlation Ventures out of the US. And the basic math is that 50% of your deals will fail completely. You've got another 46% where you're going to end up making your money back very roughly, and you're going to get half your returns from what are called your home runs. These are the 1 in 25 investments that return 10 times or more of your money. So this is basic venture math, and the math is very easy here. 1 in 25 investments are home runs. If you want a diversified portfolio of home runs, you want to have at least 20 home runs. 20 times 25, 500. There's where you get that rule of 500 from. Going to show this to you another way here. You can actually, and this is something we've done going one step further on the math, we took this distribution of returns here and we ran it through a Monte Carlo simulation. This is from a paper we published in Institutional Investor magazine back in 2020. And you can see if you take 15 venture capital deals chosen randomly from that distribution, you will get a wide variety of outcomes. And this is your typical venture fund with 15 deals. You might get a 30% return. You might end up losing more than half of your client's money from investing in that venture fund. If, however, you take that 500 investments mentioned, you can see you've got a very interesting return pattern here where your returns outperform equities, as we showed you in one of the first charts. And you will see the median investment goes up dramatically because with 500 investments, you're guaranteed a diversified portfolio, which includes home runs, whereas with 15 venture deals, half your portfolios don't even include any home runs. And this is really what the difference is. Predictable inclusion of top performers with many multiples, those top tech performers that I mentioned, which is where and how. So this is just a very interesting outcome, which is, wow, 500 venture deals, investing my clients' money in 500 venture deals, I've got something which statistically is guaranteed to outperform the S&P 500, sort of pretty well any global and equity index I want to look at. So this returns to that, the longevity risk of your clients, looking after your clients' money by giving them better returns with lower risk. Now, some of you may be thinking, aha, oh, well, hold on a second. You're talking about 15 deals chosen randomly. But what if I've got a manager? They're not choosing deals randomly. They're smart. They're picking the best deals. And this is some more data. This comes out of a group called AngelList. The Kaufman Fellow did some research on AngelList data in 2019. And many people think about venture capital as, oh, the venture capitalist is picking 1 in 100, 1 in 200 deals. They're going to pick the very best ones. And what they actually found is in venture capital, your biggest risk is actually missing out on a mega home run like a Facebook. And the data they ran said that the seed stage investors should, and again, it's not a surprise, it's indexing. They're saying indexing beats selecting almost all of the time, and that you should put your money into every credible deal. Now, there's still a big outline here for selecting a credible deal is a good skill to have as a venture investor, but you're not trying to pick the best 1 in 100 or 200. You're supposed to make sure that every credible deal gets funded. And the results were pretty stunning. They said over a 10-year investment window, indexing beats 90 to 95% of investors picking deals. So you really want to think about this indexing. You really want to think about 500 investments underlying your portfolio, and that will generally outperform even the best venture investors. Now, I'll do a little side thing here, because many of you will probably be wondering, how do you pick venture managers? It's something which people worry about a lot. Oh my goodness, how do I have access to the very best managers? Only the very best managers make money in venture. Nobody else does. And there's a lot of that thinking going around. And actually, the person who did the original thinking at Kaplan with original data from back in the 1970s to 1990s, which said, oh, you have to pick the top managers, has actually come back, and they've updated the data in the past 20 years. And they've said that actually, venture funds, which are in the top half of all venture funds, in the top or the second quartiles, are all going to outperform the S&P 500 on average. This is not consistent with the view that only very few venture funds outperform. So if you are trying to pick a manager, look, you're only trying to pick a manager who's in the top half of all managers. You're not trying to get that exclusive group, and someone who you have access to who is good, competent, should still be just as good as anyone else in there. I'm going to press a pause here for a second and say that this view that this sort of, we'll just talk a little bit about the general philosophy behind venture, which is, I've mentioned in passing private equity. I did want to outline here that private equity is very different from venture capital. It's a different kind of business, and you need a different manager running their business a different way to make money in private equity. In private equity, if you run the math, most of the returns are made from the half of your investments which have average returns. funds. So this is very much about, and only 8% fail completely. And a business which is a normal distribution business like this, where you're trying to manage to the average, is very different from how you run a venture business where you don't make your money on the average, you just make your money back. It's really about optimizing those outliers. And that leads us a little bit to questioning the nature of venture capital. Look, fundamentally, do you think about venture capital as being something, well, we have a view on this, which is private equity is about making money on average, predictably, and it's very much like cooking, where you have a recipe, you come with, you apply that recipe. Poker is a good analogy for venture capital, where your outcomes are always unpredictable. They do become revealed more and more over time. Professional poker players consistently make money, even though on any individual hand, they may lose or make a lot of money. It's about shaving the odds over time as data becomes revealed. And that's really what we think venture is about as well, is you want people who can evaluate the odds, shave the odds, and if they do that over and over, they will make money for you on average, predictably. That is what the statistics tells us. Just another thing, and this sort of leads to the humility I mentioned I learned when I started in this industry. Again, you think, oh, the top VCs can predictably select outliers. Well, maybe not. And here's some good data from Bessemer Ventures, one of the top VCs, probably the oldest VC in the US, who rejected all of Apple, Google, Tesla, Facebook, PayPal, Zoom, often for very good reasons. They told the Facebook founders, hey, kid, haven't you heard of Friendster? Move on, it's over. So yeah, selecting a good venture partner, a good venture capital manager, you want someone competent in the top half. And philosophically, you want to make sure you have your 500 investments, which you can get from multiple managers. No one manager is going to guarantee to outperform by picking winners. On average, just getting above average funds is perfectly acceptable. The last thing to mention here is, will the entrepreneur let the VC invest? This is what people more and more in the industry are saying. It's not about selection. Success is obvious. We have a company in our portfolio which in the past couple of months has been growing their revenues by 20% a week. It's obviously successful. You don't need to be a rocket scientist to go, they're doing something right here. The question is whether or not the startup lets you invest. Now, we have over a 95% acceptance rate weighted by dollars offered of our from the entrepreneurs by just giving them what they value. And if you talk to entrepreneurs, most people in VC think, okay, it's a relationship, a brand of the VC, and deal terms that matter. And if you actually ask founders, yeah, they care about the relationship, they care about the deal terms, they care about how quickly you give them money, and they care about the references they get on you from other founders. And this is how we've outperformed in our industry. This is a good checklist to actually take to any VC to really understand how are they on relationship building, what are their terms like, how quickly can they act, and what do founders say about the VC themselves. All right, so we talked about the loss risk. It's an easy thing to do, to take care of. It's the rule of 500. Let's talk right now about liquidity. The big challenge here is that most VC funds are illiquid, and the client can't access their money when they need it. And in fact, 99% of venture funds are illiquid. They've been designed for institutions. Institutions don't care about liquidity, unlike high net worth individuals. And the classic venture structure, which almost everyone follows, is it's a closed-end fund, which lasts for 8 to 10 years. There may be extensions on it, multiple extensions of 1 or 2 years each. Fund may be able to stay open for as long as 12 years. Not only that is your money gone for the lockup period of 10, 12 years, you have things called capital calls, which is if your client has to allocate $500,000 to a venture fund, the venture fund will say, great, I'll take $150,000 now, keep the other $350,000 in your bank account, and when I need it, I will ask for it. And if you don't give it to me when I ask for it, there will be severe penalties. Again, institutions don't mind. For an individual, this is a really hard thing to manage your money with money locked in cash, not earning returns, because you need to keep it there for a couple of years until the fund asks for it. You need to wait for exits. Those have unpredictable timings. And now most funds will sell off in the secondaries market, any things which they haven't been able to sell at a 20 to 30% discount. It's very hard for individuals to sell their units in a fund in the secondaries market. There are people trying more and more to get into the secondaries market, but they buy large baskets of assets, such as all the holdings from a fund when they shut down rather than the individual. So this is absolutely, for 99% of venture funds, this is the big problem, the big challenge is these cash flows. Now, some clients say, hey, if my money's going to be locked away and it's illiquid anyway, why don't I do the direct deals myself? And just that doesn't solve the liquidity problem. When you're investing in venture capital investments, they take a long time to exit. So they'll take somewhere between 7 to 9 years for half of all exits by IPO or M&A to happen. I can tell you my personal experience is my top returning investment, which I sold for 30 times the original money, took 14 years to get to an exit. So you can see why venture funds are held for long periods. It's also a fairly long time to fail. So yeah, that was the quick overview of the three types of risk. You're worried about longevity risk, loss risk, and liquidity risk. The risk of this client outliving their savings is exactly why you want to think about venture capital. The risk of loss is actually individual funds VC funds are risky, but we just showed you how to de-risk that. Is the rule of 500. And of course, one fund at 15 investments is risky, just like one stock is risky. But if you diversify properly to 500 underlying investments, this actually removes or statistically greatly mitigates the risk of loss here. Then, of course, there's the risk of liquidity, where the clients can't access the money when they need it, which the VC industry is very bad at because they've got funds designed for institutions rather than individuals. Now, I did tell you a little bit about, hey, we do well, and we are a semi-liquid fund. So let me just, actually, before I do that, let me just do one slide on timing, which is, when is the best time to enter the venture market? And of course, the simple answer is, don't try to time the market. Timing the market is for fools. You want to just generally cost a dollar average over time. But just in case you're curious about whether this is a good time to enter this market, you may have heard that in the past 2 years, tech valuations, and this is public market SaaS companies, have dropped dramatically. Look, we're a very simple industry. People try to complicate VC. It's a buy low, sell high. Buy a basket of assets low, sell the same basket of assets on average higher than you bought them. You can see where we sit on a historical metrics basis, and now is a good time to buy low. So if you're thinking of timing the market, you are lucky if you're just getting into VC now, because this is going to looks potentially, based on historical data, like a great time to buy into this market. So yeah, and there's a whole bunch of reasons why valuations are down, but it's just very simple. Now is a good time to buy low, and there are a lot of factors coming together which are putting pressure on the amount of funding going out there, and there are many good companies not being funded, and we see tens of them every month in our portfolio of companies which would have been funded by other VCs in another market 2 years ago, which currently now many people are shying away from, which leads to better terms for us when we invest in those same companies. All right, so let me tell you a little bit about Loyal. We're a diversified fund, and yeah, we really buy into diversification. We've made 350 investments to date, so we've got 70% of the 500 you'll want in your underlying fund. So we're a very good place to start. We have investments in over 60 countries. And what we're trying to do is we're trying to match global GDP outside of China, Russia, and Iran. So we've got a third in Europe, a third in North America, a third in the rest of the world. So we do a pretty good job of diversifying globally and also diversifying across sectors. Because, of course, yeah, we said diversification is the big secret to reduce risk. If you want to buy 500 investments, but they're all blockchain investments in the US, you're not practicing good diversification. So when you're buying your fund of funds, when you're doing any investments to build your 500 companies, of course, think about proper diversification of those 500 underlying assets. Don't add risk by concentrating too much in any one sector or any one country. Just to show you what this does to our returns, I'm going to step up to this and just show you that original slide I showed you of the risk and return of the different asset classes. This is what our component funds would look like if we ran an independent European firm, an independent North American firm, an independent rest of the world fund. And if you have those three independent funds, you can see they're they're pretty average performing in terms of returns, and they're reasonable returning in terms of risk, but they're not anything unusual. What is remarkable is you combine those three into one fund, and this is what you see here. So Loyal has a decent return, far better than equities, and it's got a remarkably good preservation of capital because of this global cross-sector diversification. It shouldn't be a surprise that if you diversify enough, you reduce your risk. Now, we have some secrets in our process. If anyone's interested, we'll tell you more about our process and the months to years of diligence we do on companies to reduce risk when we do invest larger amounts into them. But the last thing I want to mention about Loyal here is that we are a semi-liquid fund. So we have a price every quarter. You can buy or ask to redeem. There's some asterisks around the redemption, but very specifically, when I say semi-liquid, we can't guarantee quarterly liquidity. There are gates to protect the fund. We've had an 82% fill rate to date on 26 redemptions out of about 210 investors, and many of those are partial redemptions of people who still want to be in the fund. They just want to take some profits, help rebalance their portfolio right now, etc. We don't have any capital calls. You can stay in as long as you want. If you stay in, you will start to get distributions. Every time we sell something, there's a distribution back to the investors. So yeah, this is the model we follow. There have been around 200 or so open-ended or evergreen venture funds in the past few decades. It is something that 1% of the industry does. So yeah, that is the quick overview. We've talked about venture in a wealth manager's portfolio. It really helps protect against longevity risk. You want this outperformance. Ours is like 17% ROI over 5 years. But look at this asset class to help make sure that the clients have the wealth they need in the long term to live the life they want forever. You've got a risk of loss here, which most people look at as a reason to avoid venture. And it's only because you don't diversify. One venture fund is risky. 500 underlying venture investments is not. And you can see we've had a 7% maximum drawdown, which is far better than the equity markets, for instance, over the S&P 500, anything like that, over the past 5 years. And then the third thing is liquidity risk. And this is where most venture funds fall short. We do offer a semi-liquid quarterly fund with quarterly redemption potential. So there are a few other people like this out there. And the more you, the investors, you, the wealth managers, ask for it, the more funds it'll do it. I was talking to a venture fund manager 2 days ago who said he loved this model. He wished he could do it. And all the institutions are telling him they don't want it. So go back to venture people and say, yes, your old funds were designed for institutions. Our clients are individuals. Give us semi-liquid funds designed for individuals, and more people will start to offer it. So thank you very much. That was a quick talk. And let me turn it over to you, the audience, right now for any questions you may have. I've got a couple of questions that have come in here. I'll start in with these, but think about your questions. You're welcome to enter them in the chat, or I think let's start by entering questions in the chat, if you don't mind. That'll probably be easiest. I had one question here from one of the people who said, "What's the difference between an open-ended and an evergreen fund?" There isn't a definitional difference between open-ended and evergreen. There's a difference in practice. And the practical difference is many people refer to a fund as evergreen, as a little bit like a Hotel California. You can check in, but you can never get out. So the fund lasts forever, but there are strong limitations and long delays to you ever getting your money out of the evergreen fund. Whereas an open-ended fund tends to imply that it's got much better liquidity provisions. But I mean, if a fund is open-ended or evergreen, they're called both of those. Make sure you ask about the liquidity provisions, because that's what really tells the difference between them. And if it's evergreen, especially make sure to ask about liquidity provisions. We've got another question here about macroeconomic factors affecting the portfolio companies. Yes, I mean, generally speaking, venture capital companies are subject to the same sort of limitations that public market companies are. At a time when the economy is going hot for public companies, it's generally going hot for private companies, and vice versa. I mean, we have seen valuations. I showed you what happened in valuations in the past 2 years in tech SaaS public companies, but we have seen a similar behavior in the valuations of private companies, which is what makes this a good buying time, of course. One of the big differences is that venture capital companies tend to be at the early stage of their growth curve. So what happens is, I mentioned the company that was growing at 20% per week. That's a company hitting the fast side of its growth curve. And, you know, if the market is growing by 10% or shrinking by 10%, when you're growing by that fast, there's a bit of an influence on the market up and down on your performance. But generally speaking, the successful companies are growing very quickly. They're offering something that the market wants that isn't available. They're growing so quickly that they will succeed whether or not the markets are up or down. Whereas if you are a mature, later stage public company, your performance matters very much on the markets. And here, for top performers in venture, it matters much less. However, on a portfolio-wide basis, you will find portfolio returns in venture tend to be lower during public market down periods. Good. Are there any other questions? And I don't see any other questions tapped in the chat. Here we are, Wojtek. Wojtek says, look, global diversification looks interesting. How do you conduct due diligence, especially related to legal matters which differ among the countries? For example, there's a different legal system, political stability, et cetera, in California than in Kenya or Hungary. Do you tend to avoid that kind of countries? Good question. There are, and look, many entrepreneurs solve this problem themselves. So yes, laws matter very significantly between countries. We do find, I mean, our investments are 33% Europe, 31% US, 36% rest of the world. What we find, though, is that something like 85% of our portfolio by value is incorporated in 7 countries: US, UK, Singapore, Canada, Australia, I think Netherlands, and probably missing one other European one. So what people do when they're in emerging markets is they will often incorporate a holding company outside that market in a place with stable rule of law. That way, our rights as shareholders are protected. They have that external holding company holding 100% of the local company. And then you worry a lot less about the sort of legal matters, because as long as there's only one shareholder, the foreign holding company, there's much less room for games, et cetera, to happen when managing that. Now, we also, I mean, in our case, we have a network of 900 advisors around the world, people who are experienced doing business in each of these different countries. So we can always ask our local advisors when there are complexities. But there is the majority of our portfolio. And look, if you decide that you're going to invest in any venture fund, there are many venture funds who simply say, incorporate a holding company in Delaware, and then we'll invest in your fill in the blank Israeli, South African, Pakistani, German firm, incorporate in Delaware, and then we'll invest. So this is the process that most VCs follow, is a foreign holding, a stable holding company, a stable jurisdiction holding company holding the assets abroad.
Yeah, including IP, which we've seen move from Hong Kong to Singapore, for example.
Yeah, that's been one big shift we've seen, is a lot more concern about Hong Kong as a stable jurisdiction, and a lot of people moving to Singapore because it is seen as a much more stable jurisdiction than Hong Kong. And that was not the case 10 years ago. Excellent. Joey says, when advising individuals, his firm explained this to the clients fairly simply, as we are here to help you get to and through retirement comfortably and with dignity. Absolutely. And the reason to look at venture capital is to make sure your clients have more comfort and dignity, especially later in their life and later in their retirement. I'm sure you run the math and are very familiar with how important it is to get the excess returns from part of the portfolio. And of course, as a diversified part of the portfolio, yes, and that is very well said. I mean, it's to enhance their comfort and their dignity in the later years of their retirement. Are there any other questions or comments from people with experience in the space? This is the first time we've done this talk, so any feedback, anything that you've seen that you would like to question or ask about would be very greatly appreciated. Niti, I see your hand has gone up. Go ahead.
Thank you, Kamal. That was quite insightful. My question is that, so in a portfolio, what should be ideally the breakup between different assets for any investor? So between, let's say, index funds, other funds, maybe the stock market, I mean, different assets.
So I am most knowledgeable about venture capital, and many of the other people here are far, far more knowledgeable on the specifics of, for instance, index funds versus other public market investments. From the data we're doing, and I shared a preliminary slide from that, it looks like a market neutral weighting would be about 16% of your holdings in private equity, probably half in formal private equity and half in venture. So that would be an 8% allocation to venture. As another data point, we were talking with Michael actually was one talking to an institutional investor. Michael, do you want to tell the story about partners?
Sure. So one of our big partners we have at Loyal is INSEAD. INSEAD has a significantly sized and growing endowment. We were sponsoring a worldwide alumni event on the night before the conference started. We were invited to a Partners Capital event. Partners Capital manages the endowment for INSEAD. And they gave a good and long technical presentation about the state of the market, where interest rates are going, nominal real interest rates. And they said, look, as a result of this, we're making several changes in our allocations kind of going forward, not just for the short term, but for the medium term as well. And they were they were increasing their exposure to private equity and doubling their exposure to venture capital. So it was nice to every VC is right now who is looking to raise funds is saying now is the best time to invest in venture capital. It's true. It's nice to hear this from an allocator who is actually making these types of decisions and shifting their own allocations to this asset class. So we think it's a great asset class. We think that it's a great asset class for the mass affluent, and it's just a function of access and education. So we hope to help with both of those. Go ahead, Kamal.
And Michael, what was the specific numbers again they were increasing from and to for their allocation to venture?
So I believe their allocation was going from 5% to just over 9%.
And there you go. So I said a market neutral allocation is probably around 8%. They were at 5%. They're increasing at this market to 9%. So that probably gives you a range of where you want to be is high-ish single digits in venture capital. Now, of course, if some of your clients have some of their wealth in private companies because it's their own, I mean, look, how did your clients make their money? Many of them made it through owning private companies. They know all about you make money in private companies, you make more wealth in private companies. I mean, how many of your clients are there because they made money in the stock market versus making it from private companies? We're just saying, hey, they made their money that way, give them a chance to allocate some of their money to this asset class also. But you do need to consider their holdings of their own private company when considering your allocation balance.
So diversify not just across asset classes, but as you know, Kamal has pointed out in our materials here, it's important to get an underlying distribution so that you're not gambling. That this is a metered, considered investment.
All right. Last chance for questions before we wrap this up. Any last questions anyone still has or comments, anything like that? If not, thank you very much, everyone, for attending. Hope you've enjoyed the session. If you do want to hear more about our fund, of course, you're welcome to reach out to michael@loyal.vc or kamal@loyal.vc. If we can help you with advice, and look, we've designed a fund for individuals. We can point you to a couple of other funds. You can do the research yourself. But if you have individuals and you want to start to put them more into venture capital, we've got a single diversified semi-liquid fund to start them off at. So do feel to reach out if you're interested in that, kamal@loyal.vc or michael@loyal.vc. Thank you very much.
Thank you very much.